I'm worried that what we're seeing with the euro currency is signaling not just a recession, but perhaps a systemic banking crisis, perhaps capital exiting Europe, concerned that the politicians may respond with something that we haven't seen for a number of years, but it was on the periphery before, and that includes capital controls, as we saw in Iceland, Cyprus, and Greece, but this time, possibly to the heart and core of Europe.
If we look at the situation around natural gas and the storage facilities in Germany around natural gas, the current situation is that Germany is actually building up storage, but that's the usual seasonal pattern this time of year. The question is whether the storage is big enough to get through the winter season if the flow situation worsens even more than what we've already seen. Right now, I would argue that the Germans need a relatively mild winter to get through the winter without having to basically ration gas because they will run out of it. If we get a mild winter, they will probably make it through the winter season without having to ration gas, but they are basically in the hands of the weather right now. That's a really bad scenario. Secondly, the cost of the current gas flow is out of the stratosphere, basically. If you look at it as a percent of the gross domestic product in Germany, I think the energy bill will end up in between 15 and 20% of the gross domestic product of 2022. Someone will have to take that bill. And if the public sector takes on that bill, it will have to run a deficit of, say 15 to 20% of GDP. So we will need to add new debt on top of already existing debt in Europe to solve this situation, which may make matters worse for the metrics you just mentioned from Bank of International Settlements. So why don't we move the focus to those exact metrics? So what do they showcase, and why is it important to look at them?
It's important to look at them because private debt is more volatile than public debt. So everyone knows about Italy's terrible public debt situation, but most people don't know that in terms of private debt, they've been deleveraging for a long time, and their private debt is nowhere near as high as some other countries, specifically France. Private debt, much more volatile because European corporations can't tax the public, they can't issue new currency, whereas the governments can. So the government debt, even though it's crazy, even though it's unbelievable worldwide, it seems more stable, and more importantly, it's more liquid. That's something that Jeff Snyder and I discuss all the time on our Eurodollar University show. It's not so much the creditworthiness of these countries. The United States is terribly in debt. It's the liquidity that's so welcome, so important with these instruments. So the sovereign debt, not a focus of systemic banking crisis, whereas the private one, if it gets too big, too much, too fast, can't be serviced, that can lead to a systemic banking crisis. And so the BIS puts together data on private, non-financial corporations, and the recent tally is through December 2021. And I've got a list here of countries that have still have more private debt as a percentage of GDP at the end of 2021 than they did in December of 2019. So some countries have done a fantastic job of, yes, they had a surge in private debt because GDP fell down terribly during the COVID crisis, but then they've come back deleveraged. Those countries, Denmark, Finland, Norway, these countries have less debt today than they did in 2019 as a percentage of GDP. Now, I'm referring, of course, always to private debt. But there are countries that have more today than December 21, than they did in December 2019, and it's only going to get worse. Sweden, Switzerland, France, Belgium, Portugal, Spain, the UK, Austria, Germany, Greece, Italy, Russia, and Hungary have all more. Now, because we have that COVID crisis, it could be a big mess, right? How do we look at this data? Can we really just compare 2 years? Maybe we needed more time to recover from that bizarre, strange crisis. If you look at it over a 5-year period, the countries that still have more debt as a percentage of GDP and have more than 150% of debt, private debt to GDP, Sweden, France, and Switzerland. I know Switzerland might not count because it's an advanced economy money center, but other advanced economy money centers such as Luxembourg and I say we can include Ireland, I suppose, Belgium, Singapore, they've done better. The only advanced economy money center that has done worse than Switzerland has been Hong Kong in terms of debt load. So those are countries going into the crisis with growing piles of private debt. So that's just one measure. Another measure, similar in nature, but looking at it from a slightly different perspective, is not measuring the level per se, because I mentioned earlier, 150% debt to GDP. Maybe some countries can handle that better than others, advanced economies versus emerging markets. So what the BIS does is it looks at credit gaps relative to that country's long-term trend. So it doesn't care what level it's at. It's just saying, have you taken on a lot of private debt over a short period of time? Have you broken past your long-term trend? Countries that have triggered that warning, Switzerland, France, Germany, Norway, Luxembourg. Now, Norway and Luxembourg, they should get a get out of jail free card because they only experienced that spike during the COVID crisis. So we can explain that away. But France, Germany, and Switzerland, they all have a higher credit gap today than they did in 2019, and they've triggered that warning. If you look at just the debt service ratio, so how much income does a country generate, and how does that enable it to service both the interest payments and the amortization? Obviously, this would be a warning should interest rates keep rising. Now, before I give the surprise as to which countries have triggered the BIS early warning indicator, Andreas, let me ask you, is the ECB intent on raising its interest rates further and further into this winter in order to combat inflation, which is due to oil shocks and natural gas prices? Are they going to do that? You tell me.
Well, I think there are two answers to that question. The first answer is yes, because I mean, they only have an inflation mandate.
Okay.
But of course, there is also like an indirect mandate, which is to keep the euro glued together. And the question here is whether they can keep on hiking interest rates into a recession without compromising the stability of the Eurozone. And I think that's a very tricky question to answer right now because it ultimately depends on the severity of the crisis. But I think they will go ahead and hike the next couple of meetings. The key question is whether they can hike into the recession as they intend on doing. So the German member of the ECB board, Isabel Schnabel, she basically told us at Jackson Hole, I don't care whether there's a recession. We need to hike interest rates to bring inflation back, no matter what. But ultimately, she will be tested on that thesis, I think.
It's wild. It's crazy. I say it's crazy, but I suppose that's not the topic of our show here. If they continue to keep raising those interest rates, obviously the debt service costs should increase, putting even more pressure on the private sector, on the households, on the private corporations to service their debts. Which countries in Europe have a higher debt service ratio today than they did at the end of 2019, and therefore we can expect to have even higher debt service costs in the year ahead? Spain, Hungary, Portugal, Germany, and Italy. However, ladies and gentlemen, and dear Andreas, don't worry about those countries because, again, it's a comparison of your long-term history and whether or not you are ahead of that long-term history. So each of those countries, those 5 countries I just mentioned right now, they're servicing more debt today than in 2019, but they're nowhere near previous highs that they had experienced that were anywhere near a crisis. Countries that are at their historic highs, and we would expect rates to continue to increase, Switzerland. This is their 4th highest reading in the data series that goes back to 1999. Their debt service ratio is 19.5%. France, the 5th highest ever reading, they're at 20.8%. Sweden, this one is the one that worries us. And Andreas, we should not let them off the hook. Sweden, Second highest of the 32 country sample here of the BIS, they're at 26.6%. So they're at the second highest level of all the countries that the BIS is tracking. And this is the highest score they have on record heading into 2022. Now, Andreas, you tell me, should we be worried? You're right there in Denmark, your neighbor, Sweden. Do they have too much debt? Have you heard something in the news, in the financial media, in the press?
I mean, I live like 30 minutes from the Swedish border, so I visit Sweden quite often. And you're absolutely right that if you look at a country like Sweden, the amount of public debt is very low relative to other countries around the globe, but the amount of private debt relative to the size of the economy is humongous. And on top of that, the regular Swedish household usually takes out a mortgage loan with a fixed payment of between 1 and 3 years, maybe 5 years at the max. So that's sort of the fixing risk of the average mortgage. While in Denmark, where I'm from, the average fixing is much longer, maybe plus 10 years actually. I have a 30-year fixing actually. So I mean, from an interest rate sensitivity perspective, that matters a whole lot, because when interest rates are on the rise, it will matter to Swedish markets much before it will matter to Danish markets as a consequence of this very short maturity of the fixings in Swedish mortgages. So it's kind of scary that already before we entered 2022, the debt servicing costs were high in a relative context in Sweden, because interest rates have been on the rise on mortgages since. So scary stuff.
The BIS breaks out household debt servicing costs for a handful of countries. They only have got, I think it's 17 countries that they do this for. For the other sample, we were looking at households and corporations. And exactly what you said is absolutely true. Sweden again comes out that right now they have the highest debt servicing ratio for households in their series history at 12%. They were the only redeeming factor is that they fell just short of triggering that BIS warning line, that line in the sand. They were just decimal points short. So I don't know if we should keep them on. It's on the radar for sure. Just because they missed that mark doesn't mean we should ignore it. The ratio is higher in December 2021 than it was December 2019. And of course, now they're on verge of triggering it as they enter this year, which no doubt they will. So Sweden, many people don't think of it, but I would think that it should be on the radar of concern.
We hope you enjoyed the video. At Real Vision, we help you understand the complex world of finance, business, and the global economy with in-depth analysis from real experts. Join the revolution at realvision.com.